Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, April 12th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Lots to discuss in this video. It took me a long time to get it together because a lot of technical levels were introduced, tested. Some held, some failed, but all in all, it was not a good day for the market. Let's check over here at the trend gauge. You can see we've got neutral across the board. This is market leaders as well as the three time frames that we track: short-term, medium-term, and long-term. Yellow is a bit generous. Actually, we're waiting to see how we close the week. You can see everything is yellow with a red arrow pointing from neutral to bearish, and today played out kind of that way. So what happened? We had a CPI came out in the morning, and it was slightly worse, meaning inflation was slightly worse than estimated, but the initial reaction was a big gap up because, well, I guess because it wasn't as bad as people had thought. Actually, the NASDAQ 100 pre-market was up 2%, S&P was up 1.2%, but we were fading coming into the open. We regained a lot of that pre-market energy to the upside, but then we just rolled over and failed badly. These numbers don't really look that bad on the day, but considering how high the S&P 500 and the NASDAQ 100 were up on the day, where they closed is a resounding thud and a negative reaction to the market response to CPI. So growth continues to get sold, although growth did outperform a little bit today. So the G6 positive on the day. S&P 500 down 0.34%, NASDAQ down 0.4, Dow down 0.3, midcaps down 0.1, Russell up 1/3, mostly because of oils having a great day. 60/40 global down 0.21%, GROTECTION down approximately 0.16%. Let's get to the charts and we'll step through what happened today. But first, let's get to the team here at Revere. Trend followers is what we are. Market trending higher. We're involved to the extent that we're comfortable and our clients are comfortable, depending on their risk tolerance and what the market is showing. Market trends sideways. We take our foot off the gas a little bit. Market trends down. We apply the brakes. That's a good metaphor for how we treat things. And if you have any questions, think about this. This is pretty much how you treat every aspect of your life. If things are going badly, do you just ignore it? If your service engine soon light comes on your vehicle, do you ignore it? No, you take action, and if it's going to rain, you take an umbrella. And why should your investments be any different? Well, if you can follow the technical action, you can apply what we do. And if you're interested, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. Let's get into the charts here. So we're going to start with the S&P 500. Let me blow this up a little bit. So rough day to start the week on Monday, closed at the lows, down severely after we were testing this black line, this 200-day moving average. We popped back above it after the Fed raised interest rates here, but normal pullback, testing and holding the 21, but leaders really not getting it done with this pullback. A lot of them lower than where we started, but at least as long as we were holding above the 21 and the 200, there was some hope for the market. That was kind of dashed on Monday. But then the CPI came out. The initial reaction in the financial media was, as I mentioned, and on the market, a big gap up, almost 2% on the NASDAQ 100, over 1% on the S&P, but it was fading. We ended up opening up plus 0.7%. Let's take a look at how this played out on a 5-minute chart here. So here's your gap up. We then ran up to above the pre-market highs on the S&P. Great news, right? Nope, that was it for the day. We topped right before 10 o'clock and we started pulling back. Held the lows of the gap up so far, not a big deal. Let's take another attempt at the highs. We topped out near yesterday's highs, and that's it. We rolled over, and this is just a series of lower lows and lower highs all throughout the day. Little bump into the close. Like I said, the final numbers don't look too bad, but when you consider we're up 2% and gave it all back, not a good day in any way, shape, or form of the markets. In fact, it cements the fact that, it looks to me, and the expectation is that we're going lower. When you rally up to a declining 21, the 21 is the short term. We place a lot of emphasis on it when it failed yesterday, and we tried to get back above it today. But look how it was rejected there. That's a big negative for the market. In fact, an outside negative reversal because we closed below yesterday's lows. Also hanging out at this 4,400 level, which is kind of a key area. You can see it acted as resistance here on the way back up, support here, resistance here. It was involved in this consolidation all the way back in September of last year, and in fact, all the way back to July of last year. So it's a key level and it's holding. If I'm looking for a needle in a haystack for something positive, that would be it, 4,400. But now below all the key moving averages, that's the black 200 long term, the red 50 intermediate term, and the rolled over green 21 short term. That's no good, folks. NASDAQ 100. Same situation, gapped up. NASDAQ 100 had been a little bit weaker, didn't even make it up to the 50-day moving average, but another outside negative reversal going from at 1.2% gain pre-market down to a 0.4% loss on the day. Dow Jones Industrial Average also below the key moving averages, another not quite an outside negative reversal because it didn't get above yesterday's highs, but 3-week closing lows on the Dow. Mid caps have been doing some outperforming lately, but still outside negative reversal, ran into the declining 21 and the 50. This orange line on here is not actually a moving average. It's relative to price. It's a moving average relative to the relative strength line, something that Market Smith recently introduced, and I like it. Small caps ran into the 50 and the 21. Didn't close below yesterday's low, so that'd be a second needle in the haystack if we're looking for something positive. Let's go to the tail of the tape now, tie it all together. We downgraded the market state to consolidation with today's failure, continued to have the headwinds, VIX elevated at 24, put call kind of neutral at 0.94. So our follow-through day and the caution is being overtaken by this bear case now. Rally failure and break of reclaimed moving averages is in progress. Let's see how the week closes. But we're basically off of our bull case into our bear case now. So the news I mentioned, CPI 8.5 versus 4%, pre-market gap up, fading into open, and an epic fail. A couple things I was watching coming into today. There were some key Fibonacci levels that it was possible that we would get an undercut. And one of my scenarios was an undercut of this 43.85 level. And then a rally up into the moving average as well. We got the undercut. We got it in the middle of the night. And then we had the gap up, but all we did, again, let me show the S&P 500, gap up into this declining 21, which failed. So one of the cases for a tactical trade would have been if we'd have done this in reverse today, gap below here, found support at this 4,400, 43.85 level. and then tried to test the overhead moving averages and maybe close up around here, but we actually did the complete opposite. We had the gap up and the fail, resistance break above and failed. NASDAQ 100 also had a big fib here at the 338.22 level. Let's go to the NASDAQ 100. And, you know, we got to it during the day, but that wasn't the scenario, my preferred scenario. I wanted to test it and kind of rally off of it, but we did the exact opposite, and that is not a good sign for the market. Fade rally, fade into the trend down. 43.85 to 4,400 is this technical level here. On the day, we started out with tech, XLC and XLK, retail, and home builders acting well, in fact outperforming, but by the end of the day they were laggards. Only oils, gold, silver, and gold miners and XME ended up outperforming on the day. Healthcare was weak all day, along with KBE banks. So some portfolio changes that we made. We took our hedge off on the gap up to lock in the small profit. That's basically a flip of the S&P 500 chart. We're looking to reinstate that. Costco. One of the things that we've been doing in this choppy market is when things get extended is taking some off. We sold half of Costco yesterday, sold the rest of it today as it broke below the 80 MA and relative strength started to lag. If this comes into the 21 or the 50, we may revisit this. But right now, when you have double-digit gains in this market, you need to book them. And that's what we did there. Apple sold for a small loss. We bought this when we got back above the 21 last week, but you can see it failed Friday and Monday, rallied, ran into the 21. We took the other half off today, half yesterday, half today. Let's see what else we got stopped out on MP. This just flat out didn't work. Showed a nice bounce on Friday, holding on by the skin of its teeth yesterday, broke through the 21 today, so we got stopped out on that. But we did buy a gold stock, GFI. 211, February 11th was kind of a pivot. 211, 212 was a pivot for gold stocks. GFI actually from 211 through today is the best performing gold stock in the universe that we were looking at. When it pulled back and then got back above the 21, on Friday, tested it yesterday, was back above it today when we bought it. It closed near the low of the range, but a very tight stop to be had for GFI if this wouldn't work out. But gold stocks did outperform today, although GFI did not. So bottom lining everything, gap up gets sold into overhead decline moving averages, downgraded the market to consolidation. Not a good sign. So let's take a look at some individual names, and actually let's take a look at what we have left in our portfolio. After getting stopped, we've got a couple of good acting oil stocks. We've got Oxy, which we're slightly positive on. This is a volatile one, up 7% on Friday, down 6% on Monday, closed off of its highs today. Relative strength still a 99. It is still one of the best performers. We also still have our position in CVX that we're slightly positive on. A lot of oil stocks finished near the closing lows of their range today, as oil pulled in as the day progressed. And we're also long GFI, which I showed, and XLV, healthcare ETF. But it's had two rough days, although they're on below average volume versus the 4 of the prior 6 days, which showed big volume. So this is a normal pullback, revisiting the pivot right now on XLV. Actually, a pretty good low risk entry point. A break of the 21 would be an exit. And we also own the value half of the S&P 500. That's SPYV. Huge outperformance on a relative basis, still above its 21 EMA. So certainly looking better compared to this SPYG, the growth half, which is really dragging down the overall index, as you can see by the chart of SPY. So I'm going to stick with this SPYV as a relative outperformer. Also looking to short the S&P on a move back up into this 50-day or 21 if it would then fail. So that's something we're keeping an eye on. Some other stocks that stood out today, coal stocks were the leader on the day. BTU making new highs, Arch Coal also probing new highs. We don't have any positions in the coal stocks, but they certainly did lead today, and that should show on here. All right, that is going to wrap it. As always, I'd like to hear feedback from you. Email don@revereasset.com, the phone 855-REAL-WEALTH. Wrapping up Tuesday, an ugly reversal day in the market. Tuesday, April 12th. This is Don Vandenbord with Just the Facts. Don't shoot the messenger. Thanks for listening and have a great day.